Let me ask you something. Why does it feel that some people's money grows on autopilot, while other people are stuck trading hours for dollars? It's not luck. It's not even intelligence. It's investing. The rich don't just earn money. They deploy it. Their money works around the clock, even while they sleep. And if you're between 18 and 30, the decisions you make in the next few years could be the difference between financial freedom and financial frustration. By the end of this video, you'll know exactly how investing works, what types of assets you can buy, how returns are calculated, and how $100 today could become thousands over time. So stick around, you're about to learn the language of money. And if you stay until the end, I'll show you the one formula that separates average investors from the millionaire investors. So, what is investing really? It's putting your money to work in something that has the potential to grow, produce income, or both. You're essentially trading current comfort for future freedom. Instead of your money collecting dust in a savings account earning 0.5% interest, you give it a job to grow faster than inflation, to produce income, and to build long-term wealth. Let's start with an example. Say you have $1,000 sitting in a bank right now, and inflation is 3% a year. In 10 years' time, your $1,000 will only buy what $744 buys today. That's right, by doing nothing, your money actually loses value. Investing is how you fight back. If you think of every dollar as a seed, you plant that in the soil, say the stock market or real estate, it grows. Some grow slowly, some grow steady, others shoot up really quickly. And yes, some do die. That's what we call risk. But over time, a well-tended garden becomes a forest. You see, the trick is not timing the market perfectly. It's spending time in the market. The longer your money is invested, the more compound growth works its magic. Later on in this video, I'll show you why time is the most valuable investment tool you'll ever have, and it doesn't cost you a cent. Let's move now to the different kinds of asset classes. We'll start with stocks. When you buy a stock, you're buying a tiny piece of a company. If that company grows, so does your piece of the pie. For example, if you bought Apple shares in 2010 for $10 each, those same shares are worth $250 today. That's a 25 times return, not including dividends. And speaking of dividends, that's your cut of the profits. Some companies pay them every few months. Imagine owning part of a business that pays you just for being a shareholder. Next, we move on to bonds. Bonds are like an IOU. You lend money to a company or government, and they promise to pay you back with interest. For instance, if you buy a $1,000 government bond that pays 4% interest, you'll receive $40 a year, every year until it matures. They're usually safer than stocks, but they also grow slower. Bonds are great for stability, the steady heartbeat, if you like, of your portfolio. Next, we have real estate. Real estate gives you two potential profits: rent or income, and property value growth or capital appreciation. You might buy a $400,000 property, rent it out for $20,000 a year, and after a decade, it's worth $600,000. That's both income and capital return working together. Of course, real estate takes more effort. There are costs, tenants, maintenance, and sometimes even debt. But it's also tangible. You can actually see it and touch it. The fourth asset class are commodities. These are raw materials such as gold, silver, oil, or even wheat. Commodities are affected by global supply and demand, politics, and even weather. Investors often buy them as protection. When inflation rises or markets get shaky, people rush to gold. It's the classic safe haven. But prices can swing hard. Number 5 in our list is cash and cash equivalents. Cash feels safe, but it's quietly losing value every year because of inflation. Think of it as the slow leak in your financial tire. That said, keeping a small cash cushion for emergencies is very smart. You never want to be forced to sell your investments when the markets slow down. And finally, we have alternative investments. These are everything outside the traditional categories. such as cryptocurrency, art, private businesses, or even collectibles like sneakers or trading cards. They can explode in value, but at the same time, they can crash overnight. If you invest in alternatives, treat them like hot sauce. A little adds flavor, but too much can burn. Next, let's talk about how to measure whether your investments are actually growing and how the rich track their returns differently than everyone else. When people talk about making money from investing, what they usually mean is returns. But there are actually two types of returns. Understanding them will instantly make you smarter than 90% of new investors. The first is income return. This is the money your investment pays you regularly, like rent from property, dividends from shares, or interest from bonds. For example, if you own 100 shares of a company that pays $1 per share each year, that's $100 of income. If your total investment was $2,000, your income return is 5%. The second is capital return or capital gains. This is when the value of your investment itself increases. Let's say you buy Tesla stock at $100 and sell it for $150. That $50 gain is your capital return. Some investments give you both. For example, real estate gives you rental income and price growth. If we take another example, $10,000 invested in a company after 1 year may be worth $11,000. That would be a 10% capital return. But let's say you also receive $200 in dividends. That would be a 2% income return. To calculate your total return, simply add those two percentage numbers together to give you 12%. A moment ago, you just heard me mention the term total return. And this is the key formula wealthy investors live by. To calculate total return, you simply add income return and capital return together. Seems very simple, right? Well, it is, but most beginners forget that both of these return numbers matter. Some chase high dividend stocks and ignore growth, while others only chase growth and forget about income. The best portfolios balance both. In a second, I'll reveal the number one trap that destroys beginner investors and how to avoid it before it costs you years of progress. Here's the brutal truth. The biggest mistake new investors make isn't picking the wrong stock. It's chasing instant gratification. They see crypto skyrocketing and think I'm missing out. They dump money in at the top, then panic when it crashes. That's not investing, it's emotional gambling. Real investing is the opposite. It's boring, it's methodical. In fact, it's like watching paint dry. Until one day, you wake up and your paint is worth a fortune. If you'd invested $100 a month into the S&P 500 since 1990, you'd have about $300,000 today. If you'd only bought it when the stock market felt safe, you'd probably have half of that. You see, the winners aren't the smartest, they're the most consistent. They invest through highs and lows, avoiding headlines, because they know time in the market always beats timing the market. Right, are you ready for the part that's really going to blow your mind? Here it is. If you start investing $200 a month at age 20 and earn a 7% a year compound rate of return, by the age of 60, you'll have around $525,000. If, however, you wait until the age of 30 to start, using those same metrics, you'll only have about $245,000. That 10-year delay cost you over $280,000. That is the price of waiting. On the other hand, that's the magic and power of compound growth. It's interest earning interest earning interest. It's money making babies. Einstein allegedly called compound interest the eighth wonder of the world. He said, "He who understands it earns it, he who doesn't pays it." So, even if you start small, with $10, $50, or even $100 a month, you're planting seeds that could grow for decades. The key isn't the amount, it's the habit and the time you leave it in the markets. Now, if you stick around to the very end, I'll show you one small action you can take tonight to start building wealth instantly. So, here's your challenge. Pick one asset class you understand, Maybe it's stocks, perhaps it's real estate. And then start learning how to invest today. Set up an investment account, automate a small weekly contribution, and let time do the heavy lifting. Because every dollar you invest is a little worker, one that never sleeps, never complains, and builds your future brick by brick. If this video helped you understand investing, hit subscribe. Next time I'll show you exactly how to build your first portfolio and how to know if your money is growing faster than inflation. Because the truth is, you can either keep working for your money or stop all of that nonsense and let your money start working for you.